Well, we're getting some dumpster fires out there. AMD and Google come to mind, and we're going to cover those in some detail. But first, let's go through the breadth. Now, there is a lot to cover out there. There's a lot of news to go over as well, but I want to go through this just so you can see where we are and how this is developing, because there was a big change today, and it's worth noting. First and foremost, we have the 200, we have the 55, or rather 50, the 20, and the 5. So they go in order from largest to smallest, and then you can see the volatility, and they are the percentage of names in the S&P that are above. Really quick snapshot way to look at breadth. You see here you're at 58%, but look at this 50. We talked about this last night. That's why I always say to the 27% of the people that don't subscribe to this channel that you should subscribe and click all notifications. Why watch these? Because they're all linked. So I would subscribe if you find this interesting. Anyway, you're back over 51.49. 62.86, and then you can see the 54 down here. So we're middle of the road, exactly where we want to be, and we're back over 50. This is not mattering at all. Not at all anymore. It is no longer an issue for us. We are not overbought. We are not oversold. We just are. And to have something not matter means that we can focus on some of the other things that do matter. But we did flip back over 50. And let's rock and roll now. Now we have a ton of news to go over, and we have a ton of information to go over, but let's just do the basics first. S&P futures market back to the top of the H, the 55, the 22, and the 100, and you can see all our levels in here. What I really like about what happened today, and there's a driver for it, we can see this in the 10-year, which we're about to go over. Test the 55, rejection, and you can see that is the Friday close right there on the S&P. Test, rejection, back down to the election level. Back up, rejection, Matumbo, tries again, this time back over. This is exactly what you wanted to see. Tested 3 times, finally pushed through, and there's a reason for it on the macro front, and we're going to get to that. But then you start looking at the development of this, and it's really what you want to say. It doesn't really get any cleaner than back, retest again with the higher lows. I mean, it's pretty much classic stuff. Watch this on the hourly. I mean, it is what it is. You're going to have to just watch that 6,100 level now. Now take a look at the NQ as well, and you are going to see a little bit of a difference here where you're unable to get over, and there's a reason for that, and it's the earnings. If the earnings are not great, you're going to have an issue, and that's what we've been dealing with. That's why you're getting these lower highs, which is very different than how the S&P is setting up. But here's that level that we had on Friday, and you can see we tried to get over, failed, tried again, pulled back. This is a huge level. We've gone over this ad nauseum. You have the peak VWAP in here, the election VWAP in here. You have the 55 and the 22, and you have Itchy's conference end, as well as the July CPI month-over-month level, and I'll show you that real quick so that you can see those levels in here and see where they are. What we'll do is, just for people that are newer, and I would suggest that you subscribe to the channel, click all notifications. 27% of you don't, which is just baffling to me, the people that watch this video and don't subscribe. So I would, just because at least you can follow along with what's going on. We tell a story as the week comes on, and the story starts on Saturday with the long form video. Anyway, you can see this area here. You have 1, 2, 3, 4, 5, 6, 7 pieces of confluence sitting right in here. So this test over is exactly what you want on the 4-hour. It doesn't really get any better than that. And that's saying a lot considering some of the dumpster fire earnings that we've had out there. Now, in regards to Google, we all know what happened, and I think it's just worth reviewing here. It was an absolute mess, and we just completely, utterly fell apart. We saw the same exact thing happen with Apple, and it's just not really working on the earnings front at all, and I think that's really important. We had this like short covering. So these big dogs, it's not all the big dogs that are running, and I think that's really important. Take a look at Microsoft. These earnings are not knocking the cover off the ball, and we're going to explain why we're going to go over this and why it's so important. Let's just go out to a 5-minute chart so you can just see what a dumpster fire this really was. Now, Google increased CapEx, which is good. Meta increased CapEx. Microsoft said we're going to leave it alone. So the idea that CapEx is going away is just very simply not the case. But what's happening here is we have a new game in town, and there's a lot of risk in these names with the tariffs. So if they're not fantastic, they're not fantastic. I've seen this before. And I saw this about 20 years ago when this happened. I'll explain it. You're at the stage in AI where you're going to get clear winners. Microsoft is not winning. Google is not winning. Both Azure and cloud were off. Meta's winning. You want to start leaning towards the winners. I know it sounds so stupid, but people will bottom fish this. this is not what happens. You start getting clear winners. You know, before there was Amazon, there were 7 or 8 other book companies. So what you want to do, people don't know that. If you have to go back. People that have, back in the day, there were that many book companies. But what you want to do is you want to pay attention to this. Now, the other thing you want to pay attention to tomorrow is going to be Amazon and how they do. But you have some weakness here. You have to watch that AWS number. I don't know that that cloud business is going to be great. I'm not really sure of that. And what we're seeing is price to perfection to an extent. And I'll explain. Like Qualcomm tonight rallies up, everyone's going goofy for it, and then all of a sudden reality sets in and it drops. Now, it's dropping, in my opinion, it's kind of silly, but you know, revenues were there and they've changed the reported number. When they first reported it, they were worried about the XF, meaning the amount of exchange-rated funds. And it's definitely an issue there, but it is what it is. But you're seeing weakness here in these names. And should you be seeing weakness? I think that's something for everybody to decide. I don't know that you should be. I have ARM at the time of recording this, and I'm long, and I have calls. That was great. And they raised the lower end of guidance. They raised it up. So I thought it was a great call. I thought they did exceptionally well. But you're priced to perfection. If you're not going to do a meta, they're not going to pay attention to you. And we're seeing that very clearly right now. And there's a reason for that. Now, the first reason is services PMI. That actually got lower than expected, where manufacturing went up. So this showed a cooler number, which allowed us to get involved. And we could see that financials were going to rally because this means there's a higher degree of a rate cut. But wait, there's more. The Fed is going and doing something that they probably should have done a long time ago. And what they're saying is, yeah, we're not just going to keep increasing the amount of debt out there forever. And so what they're doing and what Treasury's doing here is bond issuance is going to be steady. And this came out today at 11:30, and we're going to talk about the bond market in a second here. Why do you care about this? Well, when you have an issue, there's 2 things. If you have credit card debt that you have to pay, there's one way to get it down, right? Have a hamburger instead of having the steak. Start reducing your expenses. And this is where Doge comes in, or them reducing expenses. I don't care if you like it or you don't like it. It's just a fact. If you reduce your expenses, then your credit card bills aren't as much as they were, right? You have more money in your pocket. Them stating this, it's very clear which way they're going, and they understand that they have to bring their costs down. So the idea that they're going to bring their costs down does 2 things. One, it makes the bonds more valuable, because they're saying you're not going to just have this steady flow. You're either going to have to buy this bond or not. So now what happens? Demand increases. Why? Because supply decreases or remains steady. Either one of those is going to increase demand, which makes yield drop even more. So now I'm getting numbers out of services PMI that's dropping me. We had some really good numbers on the JOLTS number that's dropping us, that's having less jobs available, right? This is what's good for the bond market, not what's good for the economy. And therefore, yields are going to drop. And on top of that, what they're doing now is they are saying we're going to keep the amount of issuances steady, even though the previous administration wanted to increase them. That's a lot of arrows. What all this means to you is yields are going to drop. And that means that financials, capital markets, all those names that are out there, they're all setting up to move higher. But wait, there's more. The Fed is saying that the U.S. Treasury Secretary, Trump administration, 217, tax permanent. So that's the goal. We want to make these tax cuts from 2017. We want to make them permanent. So in other words, we're going to keep more money in your pocket. We're not going to increase the deficit as much. These are the plans, guys. I don't need the comments of your political beliefs below. This is what they're going for. If they're pulling this off, that means that GDP will go higher, yields will stay lower, people have more money in their pocket. This is the game plan. So I'm going to tie that in with the bond market in a second, but I want to go through this, why I'm on the slides, which is smart money, dumb money. Now, the reason that I'm going over this is because I was asked to follow up in your comments. I read every single comment, whether or not I respond to them. So just keep them coming, and I will follow up even if I don't respond. But I do try to respond to every single one of them. This is by Sentiment Trader. This is not me. I have no affiliation with them. Excuse my crude drawing. What we're going to look at here is we don't call this smart. We don't call this dumb. This is institutional. This is retail. Just remember that as we go forward, okay? Because it's going to make a lot more sense. So what's happened again is that we're starting to move higher in the market, and we have institutions that are out of position, and retail is loaded for bear. Now, retail can either start selling, and retail does move faster, and we know that institutions move like a turtle. So if we start seeing retail plummet, Well, that could mean that institutions are just going to slow down and just let it come to them. What we want to focus on is what we talked about 2 weeks ago was this cross, and that these crosses tend to mark bottoms. So what I want to do is follow up on that and say, did that mark a bottom? And the chances are that, yes, it did. It does seem to have marked a bottom. And you'll remember when we went through this before, and it's really when the retail side crosses the institutions that we tend to get these bottoms in here over and over again, right? And we're just looking for those little areas where you have these crosses. Does it mean that every single one is going to work? No. It does not. It does not mean that. But it does mean that it becomes a place of interest. Some of are just going to roll over again, and this is where you had $1.7 trillion injected in the market, so it's kind of hard to even look at that with a straight face. But what we're seeing here is we're seeing this hold, which is good. Now, if we drill into it, and the whole purpose, again, of creating this content, guys, is for you to be educated and to learn. So just keep throwing things out there that you're interested in, and I'm more than happy to cover them. You're starting to see that kind of like rolling here, and this is starting to pick up. What I want you to take away from going from a 3-year to a 1-year are a couple things. Has this flip been marking bottoms this past 12 months? Right? So in other words, what kind of environment are we currently in? And you would say that, yeah, it has. And then here we are again. Okay, if we bought there and we looked out 3 months or 6 months, did we do okay? Yeah, if we marked here and we said May and then we went out 1, 2, 3, all right, so we'll come to here. Did you do okay? Yeah, you did pretty well. All right, so then where's the next one? And you would say, well, you have one here and you bought that. Okay, if you bought that and you went out 3 months, did you do okay? Yep, you did pretty well. Here you are, okay? Go out 3 months. You don't know that it's going to happen. It's one data point. And to not look at it and not look at the positioning is a huge mistake. I will point out something that I think is glaringly obvious to everybody, but I'm going to point it out anyway. When we've had these crosses in the past, when they've happened, you have been in a position where you've had way more invested capital on the institutional side, and you can tell how invested they are by where they were. So you were here last time, so they had more invested capital on the institutional side. Can you start seeing why it might be important to start referring to this as institutional and this is retail? So when you see this right here, you're at, let's say, a 0.6 on an institutional investment level. If you think about it that way, it might make a little more sense. You're at a 0.6 there. Where are you here? 0.45, let's call it. So you have the ability to have more institutional money flow into this faster than you have in the past because of where you are, which means this could go on longer. And then you look at the trajectory of smart money or institutional money come in the market versus how it moved last time. And I think you're going to note something, that this is actually speeding up the rate of change. And we're going to get into the rate of change on Saturday in Saturday's video. This is really important to note about the flow of the money and how it's going, but it's also going into different sectors, and we're going to talk about that now. Now, when we see a situation where we have yields dropping, which we do, we broke a critical level. That 450 cracking that on the 10-year, that is absolutely huge. So when we broke that, you've opened up the floodgates to a couple key levels. Number one, the home builders. Okay, the home builders, whether they're going up or not, you're going to start seeing demand in the home builders. You will start to see that. You will start seeing demand in regional banks. Obviously, DPST is the 3X ETF, but you guys already knew that, just a refresher. But what we're seeing here with the XLF, take a look at this when we start looking at the basics. We start seeing Goldman, new closing high. And you start to see this stuff all the time. JP Morgan, new closing high, all-time high on JP Morgan. So when you have the amount of money that's flowing into the market, do I really need to play around with Tesla? I mean, when you start to understand that the reason it's down, and I'm going to get into this on Saturday, is because of the X bonds. See, what people don't understand about this is if Morgan Stanley is actually selling X debt, Twitter debt, at 97 cents on the dollar, if they're taking a loss on Twitter debt, do you think they're really going to be in a huge hurry to finance Tesla? If he needs bonds or anything like that? The answer is no. It means the cost to carry is going to be higher. And if that's the case, then this is going to have a problem. It's the same thing that you're going to run into with MicroStrategies. I could spend an hour on this, but the fact that he's got to pay 8% now to get money, I don't care if you're getting 10 times the amount of stock or whatever, it's 1/10 the stock. It doesn't matter. The bottom line is people would rather have debt now than the equity, whether it's 1/10 or not. And he's still got to make a dividend payment. So that becomes the cost of goods. It's the same thing with the Fed funds. This is what people don't understand, right? So when you go and take a look at something like Fed funds, for example, let's pull that up a little faster this time so we can get this done. But when you start looking at Fed funds and you realize like, oh, okay, Yeah, when you're having your converts on MicroStrategy's at zero, ZIRP, zero interest rate premium, right down here. Yeah, you want to go open up a taco stand and set up a website for it? Go for it. You'll go raise millions of dollars. All of a sudden, you got margin interest? Yeah, you have a problem. All of a sudden, it's not going to be as hot. You're not going to want to pay attention to it as much. And all of a sudden, people are going to start seeing the words margin interest in their portfolio. And where's that going to take them? Right? It's going to take them into understanding why IBKR is breaking out and hitting all-time highs. That's where this is going to take them. It's going to make them understand why Hood's making money and what that margin interest is and what it's actually doing. This is what people are missing. I don't need tech anymore. I have more, easier earnings with financials because interest rates are up again, so money is flowing into this. This is why it's so important to get this. This is why Sophie's rallying, not because you're smart, but because all of a sudden the margin interest is kicking in and all of a sudden they're making money on their spreads again. Please understand that. It's a really key thing when you understand macro, why you have to pay attention to this. I can't stress this enough, guys. You can actually do very well with financials in this market when you understand how it works. And we have obviously the non-farm payrolls coming out. That said, you are seeing a couple key things that I do want to point out here. I'm going to get rid of all my nonsense. Names like NVIDIA. I love NVIDIA. 55.22, 12 pointing down, guys. I'd be remiss to not point it out. The only saving grace I see is you got back above the 200-day. You need to stay up here, and I'm not sure that is going to happen with Qualcomm being down tonight on fairly good earnings. You're down $10. ARM had really good earnings, in my opinion, and you're down $10 as well. Now, how these close remains to be seen. You had AMD was literally a dumpster fire floating down the river with a bunch of raccoons, and here we are, and it actually traded up. That is it.